Let's shift focus and talk about all these stocks which are the newsmakers this Wednesday morning. Mayuresh Joshi, fund manager at Angel Broking, joins us on the show right now. Mayuresh, hi, good morning. Have to begin with Sun Pharma. Now that the EIR by the US FDA for Halol is in place, would you say though that there could be limited upside, because analysts, I understand, have already penciled in this clearance coming in their FY19 estimates. The stock is already up 15% in the last 3 days.
Morning, Aish. I think if one really goes by the transcript and the con call post Q4 numbers, the management did indicate a double-digit revenue growth for the company in the second half. So you're right. A lot of analysts on the street have penciled in a double-digit revenue growth for Sun Pharma. But again, I think the positives with the specialty pipeline that Sun Pharma does possess and the monetization thereof is going to be extremely critical in terms of the overall earnings estimates for FY20 as well. So they've got a slew of specialty launches that can probably get lined up. So you've got Yonsa, you've got other specialty chemical drugs as well, which can actually do well in terms of both the exclusivity period and the kind of pricing that they can probably enjoy. So the pricing pressures which led to earnings downgrades, the issues related to Halol did have a bearing on the stock. But again, I think the earnings probably for FY19 at least are well captured in the price. If you look beyond FY19 and if one really assumes all these monetizations to probably have a positive impact, I think shareholders will probably held on with a lot of patience. This is the time to probably hold on because the clearance probably gives far greater visibility FY20 onwards.
Begin trade. Mayuresh, what is your understanding of this buyback? Like Madhu pointed out, it's not like the success rate is going to be very high given where the stock is positioned right now.
Morning, Tanviro. Absolutely. And again, I think in terms of the core dynamics, I think it's not going to create a huge amount of euphoria in the sense of a premium to the current price. So in that respect, yes, I think the improvement in ROEs is given. But to a large element, as Madhu was also pointing out, I think a lot of the top-tier managements have indicated to distribute either in the form of dividends or the buybacks that they're probably doing on the free cash flows that they generate. So largely, I think it's going to be element in terms of their core performance, and specifically, I think revenue growth is able to generate both in dollar and constant currency terms, which the TCS management has guided for pretty decently. So I think we maintain a positive view on the stock. But I think one does not necessarily need to play out on this buyback. If one really has a long-term view, I think one can really hold on to top-tier IT names even at this point of time.
Okay, that's that on TCS. Mayuresh, the telecom sector and the war intensifies. We are tracking, I think, a level of 1,011 on Reliance Industries, if that would be its fresh record high. What are you making of the new data plan and what it does? Do you think the market can have a bit of a sentiment tilt towards RIL today morning?
So it will, and this is keeping on happening, Tanvir. So I think a couple of quarters back, we are probably talking about the downtrading in ARPUs probably coming to an end. But a large element in terms of the competition intensity, specifically with relation to pricing, is still continuing. So I think the RIL quest or the Geo quest in terms of gaining both the subscriber market share and the revenue market share probably still seems to be on their agenda. What they've probably done is they've gained a tad bit, but Bharti and Idea have probably held on to their ground, specifically in terms of the subscriber market share. A large element in terms of how the ARPUs are faring at this point of time, specifically the data ARPUs, I think they'll still remain constrained. So though I think the number of players have probably shrunk to 4 or 5, including the PSU players, you're probably looking at stickiness in terms of reported numbers and cash flows still remaining very, very constrained for the incumbents. So the capex plans that they've announced, the kind of operating expenses that they've got on their balance sheets is clearly not going to allow free cash flows to probably have a greater say in terms of return ratios. So yes, sentiment positive, but even the core businesses that we are probably on the right track. What they've also probably announced with BP in terms of exploration, I think that also can be something which can be looked at a few quarters down the line. So yes, I think RIL is something that I have to remain positive about, remain positive, and a clear disclaimer. I own this stock in my funds.
Mayuresh, we're stepping into trade, just about a few minutes to go. We've been talking about the move in, some of the metal stocks over the last few weeks. But, off late, that trade has kind of taken a back seat. Do you think there's still momentum left in the run for metals? The major metal stocks especially.
So Tanveer, again, I think if you have to bifurcate within this space between ferrous and the non-ferrous guys, yes, I think the inherent demand specifically for steel still remains extremely buoyant at this point of time. What you probably looked in terms of realizations of long product prices actually moving up is going to affect the earnings for a lot of steel companies who are basically into this stream and have value-added products from the other segments as well. So I think steel makers domestically still look good and in a good stead, both in terms of realization growth actually coming through. And though input costs had moved up sharply over the past few quarters, both in terms of iron ore and coking coal, you're seeing some cool off happening on that front. So with the EBITDA per ton should also probably start moving northwards for these companies. So it's a clear case of operating leverage with volume offtake happening at a very decent pace, margin stabilizing, giving an effect to the return on capital employed. Having said that, I think players like JSW Steel should probably still be held on. In terms of valuation from an FY19 perspective, on an EBITDA basis looks fair, but again, I think the inherent trends look extremely strong. Again, NALCO in terms of the aluminium plane, specifically in terms of alumina, where the prices have gone through the roof. My own sense is that even after the internal captive consumption for its aluminium production, where the prices are also looking reasonably stable at this point of time, the alumina division and the EBIT thereof can substantially improve their earnings as well. And Vedanta as a play in terms of all its integrated operations and again the cash-rich balance sheet that it probably possesses at least at this point of time, and the dividend payout. I think they look reasonable bets within the metal universe over the medium term.
We've been talking, Mayuresh, about IT and the TCS buyback, but what really is happening within the larger IT basket? I was just chatting with Kunal about Tata Elxsi. What are some of the mid-cap names that you at Angel are betting on even now?
So Aisha, I think in the past we have like Cyient and Mindtree, and again the growth in terms of dollar revenues as well as their margins did held on pretty well. So I think the kind of price movement that you've seen in both these stocks has been quite exemplary. At this point of time within the mid-cap IT basket, Nucleus Software is something that we will continue to pursue and like. What they've probably done with their FinnOne new Exeo platform and the kind of capex that they've incurred over the past few quarters, I think it is well behind it now. So I think with more emphasis being laid on cloud, a lot of these NBFC companies actually coming in for their licensing requirements, specifically in relation to cloud computing, I think Nucleus probably has an edge out there. Only a 5-6% contribution at this point of time, but as their entrenchment grows further and with the expansionary mode that they probably have envisaged, you're probably looking at greater revenues coming through. So the overall dynamics on their balance sheet, what can come through in terms of their intrinsic cash flows over the next few quarters and years can be quite substantial. So again, I think in terms of margin profile, in terms of the earnings estimates, we remain extremely sanguine in terms of what the company can actually deliver over the next few quarters. So I think Nucleus Software at this point of time within the mid-cap IT basket would be our top pick.
Okay, Mayuresh, NP completing 25 years since listing, how do you now look at the NP versus TCS story? Do you think NP in a meaningful manner has lost momentum with TCS really being the dominant player in the sector now?
So no two ways about it, Tanveer. I think if you lay out a chart of the last few quarters, you've obviously seen TCS outperform both in terms of volume growth that it has probably delivered, both in terms of the dollar growth as well as a better margin profile. Having said that, I think the kind of segmental performance that TCS also has delivered has been quite exemplary compared to Infosys. So Infosys clearly struggled in terms of both client mining, in terms of the management transition that it probably went through, and probably the investments that were required a few quarters and years down the line, specifically in terms of digital innovations. So all those efforts have now started bearing fruit, specifically on the digital front, where TCS had an advantage over Infosys. But a large element in terms of probably having a lot of emphasis at this point of time on these core sectors, and again their entire strategy going forward and effectively having their utilization levels actually getting propped up, and execution patterns also improving, along with client deal wins actually improving as well across subsectors. I think that should improve the dynamics in terms of how the overall performance of the next few quarters can be. Otherwise, I think the dynamics remain the same. I think the cash flows that both Infy and TCS throughout are quite substantial. As we discussed earlier, I think the payouts, both in terms of dividends, are going to be substantially higher and in consistency with what they have actually announced. So a large element of dollar revenue growth being very stable, with BFSI actually expected to do well with the corporate tax cuts in US, can actually hold them in good stead. So I think as Infosys starts delivering, I think the gap that they probably have with TCS should start narrowing down. But TCS is also probably outperforming in these subsegments. So I think it's going to be a decent show from the top tier IT companies.
And Mayuresh, what would be some of your top mid-cap high conviction ideas ahead of trade, if you could quickly line them up for our viewers?
So Tanvir, I think LT Foods is something that I probably like on declines at this point of time. What you've probably seen in terms of their market share dominance, they've got a 22% market share in the domestic market. Their brand Royal is very well known in North American markets. Daawat is how it is known in the domestic markets. They've got a well-entrenched distribution networks, 140,000 retail outlets covering towns of more than 2 lakhs. You've also got probably 3,000 odd wholesalers. They cater to specialty hotels and restaurants with a 50% share in that front. And a large element in terms of their offerings, I think both Basmati, non-Basmati, is where I think the value addition actually comes from. They've also tied up with a Japanese company in terms of creating rice-based snacks, which in my opinion can really do well over the next few quarters. In terms of financials, our own expectations are top line growth of 12%, the bottom line growth of 17%. The margin dip that you saw in Q4 were more or less in terms of investments that they're done in the European and the US subsidiaries. But again, I think the higher depreciation amount should slowly and steadily start coming down as the utilization level starts coming through and the fixed cost absorption starts happening more effectively. So I think the margin stability at 10.5%, 11% and the ROE expansion will probably lead us to believe that an EPS of 6 rupees can be delivered by FY20. So on the valuation basis, I think looks extremely attractive at this point of time. So any decline in a staggered way is how long-term investors can actually look at this.
Okay, Mayuresh, we're going to let you go on that note. Thanks much for taking out the time and chatting with us about the fundamentals that the market is dealing with. Just 30 seconds and we should hit the opening bell for this.